S&P 500 futures are down about 0.3% this morning. The Nasdaq is sliding a full 1%, and the Dow is essentially flat. You're looking at a pre-market tape that isn't just red. I mean, it's telling us a massive structural trap is being set.
Yeah, the implied open we are tracking right now suggests a highly defensive posture across the board. Institutional allocators are moving aggressively, and they are definitely not waiting for the opening bell.
Right. Okay, let's unpack this. Because to understand why those futures are bleeding red, we have to look at the massive catalyst that hit the wires over the weekend. Our mission in this deep dive is to unpack a stack of urgent institutional notes we got this morning regarding the military escalation near the Strait of Hormuz.
Right, involving the fresh U.S. airstrikes and the Iranian retaliatory attacks.
Exactly. And, to be totally clear with you listening, our job here is absolutely not to weigh in on the politics of this or to endorse any side of the conflict. We're strictly here to impartially report the facts from these sources and decode how this event is violently reshaping global shipping and capital flows in real time.
Because the market tape, it doesn't possess a political compass.
Yeah.
Right? It only processes supply, demand, and risk. And the supply risk just went parabolic.
It really did.
Iran has effectively closed the Strait of Hormuz until further notice. And for context, that strait is basically the geopolitical jugular vein for global energy. A massive percentage of the world's daily oil consumption goes right through that narrow waterway.
So the immediate domino effect in the pre-market is pretty violent.
Oh, absolutely. Brent crude has spiked over 4%, up 4.28% to be exact, pushing up to $79.26 a barrel. And West Texas Intermediate, the U.S. benchmark, is jumping as well, up 4.37% to $74.53.
Which is a massive overnight repricing of global energy. I mean, if you're a manufacturer or a logistics company, that spike acts as an immediate, unavoidable tax.
Yeah, and if we connect this to the bigger picture, it violently revives inflation fears at the absolute worst possible moment on the economic calendar.
Because we have crucial midweek inflation data coming up, right?
Oh, right.
The CPI and PPI print.
Exactly, dropping in just a few days. And add to that, newly appointed Federal Reserve Chair Kevin Warsh is heading to Capitol Hill this week for testimony. He was walking into those hearings with energy prices exploding on his screen. Lawmakers are going to demand answers on how he plans to contain it.
So it's like we just threw a geopolitical wrench into the inflation engine, right?
Yeah.
But I actually have to push back slightly on the market reaction here.
Okay, go ahead.
I look at the board, and the Nasdaq is taking the biggest hit by far. A major software firm or an AI hardware company barely uses any crude oil compared to, like, an airline or a trucking fleet. So why does a $79 barrel of oil suddenly trigger a massive sell-off in Silicon Valley?
That's a great question. It's because of how energy prices manipulate the foundational cost of capital. Tech stocks aren't being sold today because their shipping costs went up. They're being sold because of what the institutional notes are calling a dual-engine headwind.
And the first engine is the 10-year yield, I assume.
Spot on. The U.S. 10-year Treasury yield. When oil spikes, bond traders instantly price in the reality that inflation is going to remain sticky. If inflation stays hot, the Fed cannot cut interest rates.
They might even have to hold them higher for longer.
Or hike again.
Yeah.
And that sends the 10-year yield surging. Right now, it's sitting up near 4.58%.
Wow, okay. And the second engine of that headwind?
The U.S. dollar index, the DXY. In times of severe geopolitical panic, global capital flees volatility and seeks the ultimate safe haven, which is the U.S. dollar. The DXY is muscling higher this morning, hovering right at 101.13 after hitting a high of 101.22.
Wait, I understand why frightened capital moves to the dollar, but how does a strong dollar actively destroy the value of a tech company that, builds software in California?
Because those mega-cap tech companies are massive multinational corporations.
Yeah.
Let's say an AI software firm sells a $10 million enterprise license in Europe. They get paid in euros.
Right.
But they report their earnings to Wall Street in U.S. dollars. When the dollar is historically strong, those euros convert into significantly fewer dollars. The company didn't lose any customers, their product didn't get worse, but their reported revenue artificially shrinks. It's just a silent killer of tech earnings.
So on one side, a strong dollar is quietly eroding their overseas profits. And on the other side, rising yields are attacking their valuations. Which actually brings up a fascinating behavioral dynamic I'm seeing in the notes.
The retail trap.
Yeah. Usually when tech drops a full % in the pre-market, retail investors swarm in. Buying the dip on tech has been the easiest winning playbook for a decade. Why are the institutions screaming that today is a trap?
Because retail investors are largely ignoring what institutional allocators call the pain trade. A retail trader looks at a stock down 5% and assumes they're getting a discount. But the sources highlight three structural phenomena proving the intrinsic value of these companies is actually shrinking. The first is multiple compression.
Walk us through the mechanics of that. Why does a rising 10-year yield compress a company's multiple?
Think of the 10-year yield like financial gravity. High-growth tech companies are valued based on the massive profits they are projected to make 5 or 10 years in the future.
You're right, the discounted cash flow.
Exactly. To figure out what those future profits are worth today, financial models use a discount rate directly tied to the 10-year yield. If that yield, the gravity suddenly gets much stronger, it pulls the current valuation of those future earnings violently back down to earth.
The underlying asset didn't change, but the math did.
Precisely. You aren't getting a discount on the stock. The stock is just mathematically worth less today than it was on Friday.
So basically, retail traders think they're buying a designer shirt on clearance, but institutions know the store itself is on fire.
That analogy hits the mark perfectly. And that leads to the second phenomenon, the death of the equity risk premium, or the ERP. It's the extra return an investor demands for taking on the high risk of the stock market compared to a totally risk-free government bond.
Right, so put yourself in the shoes of the listener for a second. If you're a portfolio manager running a $50 billion pension fund, you have strict quarterly targets to hit.
Yes. And right now, the U.S. government is offering you a guaranteed, highly competitive, risk-free return of 4.58% on the 10-year Treasury. If you can lock that in with zero risk, why gamble billions in volatile tech stocks just to squeeze out a slightly better return?
You wouldn't. The math just doesn't justify the risk.
It doesn't. So institutional capital quietly rotates out of high beta tech and parks itself in defensive cash or commodities. But I'll ask you, what stands out to why you do when you look at this dynamic?
Well, what stands out to me is how dangerous it is to fly blind right now. Because that makes sense for the trillion-dollar mega caps. But what about the smaller, speculative tech companies?
They're facing the third phenomena, the mid-cap refinancing squeeze. These smaller growth firms rarely generate enough free cash flow to fund their own expansion. They rely heavily on constant access to cheap debt, they take out loans, and when those mature, they roll them over.
But if yields are spiking, rolling over that debt suddenly becomes incredibly expensive.
Devastatingly expensive. If they borrowed money 3 years ago at 2%, and now they have to refinance that exact same debt at 6 or 7%, their interest expenses explode. It sets up a severe debt refinancing squeeze that completely wipes out their operating margins.
So you have institutional money playing a balance sheet game, moving to safety, while retail money is just blindly buying the dip. We really need to look at where the literal breaking points are on the charts today, because last week closed on a multi-week technical breakout. S&P was up 1.2% on the week, Nasdaq up 1.7%.
Yeah, the bulls were popping champagne on Friday.
Right. So let's lay out the game plan. Starting with the S&P 500, Friday closed at 7,575.39.
Okay, so to the upside, there's minor resistance right near 7,580. But the key psychological overhead is 7,600. If the bulls can somehow pull off a daily close above 7,600, it neutralizes the bears completely.
But with yields rising, the downside seems much more probable. Where is the floor?
The intraday pivot support is around 7,545, but the absolute line in the sand is 7,508. If the S&P loses 7,508, the breakout is officially dead.
And what happens mechanically if we breach that line?
It triggers a slide down to 7,480. All those late-stage Friday bulls realize they are underwater, and it ensnares them in a painful liquidity trap. Algorithmic selling just accelerates the downward move.
Okay, and that brings us to the Nasdaq, where the numbers are just staggering. Friday closed at 29,825.11. Resistance is at 29,857, and then you have that massive 30,000 barrier looming over the market.
And breaking 30,000 would require overwhelming institutional buying volume, which is currently fleeing into cash and energy. So the downside risk on the Nasdaq is really the paramount story. The critical intraday pivot is 29,620.
And if they fail to hold that, where is the Nasdaq's absolute line in the sand?
It's 29,484. If yields surge with crude oil, breaking 29,484 means a rapid flush all the way down to 29,250.
Wow. And here's where it gets really interesting. Because this isn't just about abstract index numbers, it's about massive individual companies dragging the market around. And the pre-market action on specific tickers today is an absolute bloodbath in the semiconductor space.
It really is a severe reality check for global chips.
Just look at SK Hynix. Their ADRs debuted on the Nasdaq last Friday, and it was a blockbuster event. Fast forward to this morning, and it is plunging 10.4% in the pre-market, completely erasing its debut gains due to this global chip anxiety.
And it's dragging Micron Technology down 6.1% right alongside it.
Exactly. But I think the most illuminating ticker in the pre-market today is Taiwan Semiconductor, TSM. You called it a paradox in the notes.
It is an absolute paradox. TSM just reported a massive June sales surge, up 67.9% year over year to $15.1 billion. And their first half revenues are up 35.6%. By every traditional metric, this stock should be rocketing upward.
Yeah, I'm looking at the tape, and TSM is trading basically flat to down, bouncing between $434.76 and $438.09. How does a company grow sales by 68% and get ignored by the market?
Because today, macro fears are completely overshadowing stellar fundamental earnings. Investors are looking forward, seeing closed shipping lanes and spiking yields, and they refuse to pay a premium. The technical levels here are razor thin. Clearing $440 opens a path to $450 ahead of Thursday's earnings.
But if they drop?
A breach below $430 exposes a drop down to $415. It perfectly illustrates how a macro valuation squeeze can trap even the best companies.
And we see the same thing with NVIDIA this morning. It's sliding roughly 1.3% to around $208.28. And that's despite elite corporate governance news today that former Goldman Sachs executive Suzanne Nora Johnson officially joined their board.
Right, the tape completely ignores it. Institutional algorithms just don't care about a board appointment when the sector is pulling back. For NVDA today, reclaiming $215 shows institutional defense, but dropping below 200 triggers massive momentum selling toward 190.
So, if money is aggressively rotating out of high beta tech, it has to land somewhere. And the notes are overwhelmingly pointing to the energy sector as the strongest pre-market space today, specifically ExxonMobil.
Yes, ticker XOM. They are perfectly positioned to be the prime beneficiary of this. Structurally, the old New Jersey domiciled stock is being replaced by the new Texas domiciled entity on the NYSE today. But fundamentally, it's about their supply chain.
Because they have fresh oil coming online right as the Strait of Hormuz is choked off.
Exactly. They're fueled by the $1 billion Usan infill project in Nigeria, which is adding 40,000 barrels per day to their capacity. Combine that with the crude spike, and they are the prime winner.
What are the levels for Exxon today?
A breakout above $146.44 targets 150 plus, while slipping below $137.81 exposes a correction back to 135.
So what does this all mean? We're looking at a market caught between an AI rally and the cold reality of geopolitical conflict. The overarching theme from every note today is that you simply cannot fight the math.
You truly can't. A strong dollar and rising yields form a restrictive ceiling on equity valuations, and institutions are quietly preparing for a higher-for-longer inflation fight. The listener needs to keep an eye on the 10-year yield and Brent crude. Those will dictate if today is a healthy pause or a devastating liquidity trap.
It all comes down to the foundational cost of capital, which leaves us with a final provocative thought for you to mull over on your own today. We obsess over the Federal Reserve tracking interest rates. But if geopolitical supply shocks, like a blocked shipping strait, become the primary drivers of inflation, how effective can central banks actually be? I mean, if raising interest rates doesn't reopen a shipping lane or pump more oil, are we entering an era where the Fed's traditional tools are fundamentally broken?